You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Next, we're gonna go start with our panel, 2021, the year that changed everything. And I'm going to introduce our panelist, Mark Longo from Options Insider, who's going to introduce the panelists.
All right, everybody. Welcome to the Options panel, aka 2021, the year that changed everything. It sounds like hyperbole. Maybe it does, but from an options perspective, it certainly is relevant. Obviously, we were supposed to do this back in January, so we were coming hot off the heels of this explosive, insane record, whatever you want to call it, year. And now we have the benefit of a couple extra months of hindsight behind us. We can kind of look back with a little bit more informed perspective on the absolutely insane events that occurred last year. We saw, historic firsts. We saw game-changing developments in the world of options. I'm going to spend the next roughly hour or so breaking all that down. For those of you who don't know me, my name is Mark Longo. I started as a market maker on the floor of the Cboe many years ago. You probably know me best for the last 15 or so years. I've been the voice of the Options Insider Radio Network. We created the first options podcast many years ago, and it has morphed into a network of content aimed at all different aspects of the options space. So for us, it's been fascinating to watch the evolution over the last couple of years of just how much this market has evolved. But of course, it's not just me here on the stage today to break down the insane year that was 2021. To my immediate left, I'm joined by Jordan Naylor. He is the CEO of Matrix Executions. Next to him, we have Bill Looney, the Managing Director and Head of Global Business Development over there at XFA. And last but not least, all the way on the far end, the guy who gets the award for the longest business card on the panel, Henry Schwartz, Senior Director and Head of Product Intelligence, Data and Access Solutions at Cboe Global Markets. All right, we're supposed to have a fourth. We're going to be joined by Greg Magadini from Genesis Volatility to break down all the insanity in the world of crypto derivatives. Unfortunately, as is often the case right now, he was struck down by the modern plague just yesterday, just the day before the show. So hopefully he's feeling better. We're going to soldier on without him here, but a lot to get into. Let's start with kind of the big story that was for the option space last year. It was the volume story. 2021 just blew the doors off from just about any metric you could put at it. Looking at domestically first, OCC numbers for the end of last year, almost 10 billion contracts changing hands last year, 9.93 billion to be precise. That blows the doors off the 7.5 billion that came from the already previous record year before it, 2020. That's up about 32% from the year before. And these are numbers that, if you had talked to people in and around the business for a long time, they thought they weren't impossible, but they certainly wouldn't be numbers we were going to see anytime soon. Yet we saw back-to-back explosive years, 2020 and now 2021. Fast forward to the global setting as well. Total global derivatives, so futures and options, 62, almost 63 billion contracts last year. That's up 34% from, again, an already record year of 2020. If we drill down to options, that was 33.3 billion, so roughly half of that number. That was up 57% from the year before. And again, 2020, we're not talking a quiet year. And for this audience in particular, equity derivatives accounted for the majority of that growth. They were 41.6 billion contracts, equity derivatives last year. That was 47% increase from the year before. And another interesting data point a lot of people were talking about towards the end of last year, a historic one as well, looking at a little bit maybe the tail wagging the dog a little bit, because obviously options are derivatives, so they go where the stock leads. But at the end of the year, we saw that notional ADV, that notional volume in options, actually eclipsing stocks for the very first time. Single stock notional volume at about 467 billion versus around 410 billion for stock. So these are numbers and levels that we have not seen before, which makes it an interesting year to talk about. And we have a great panel to do just that. Let's go the opposite of the way we went. Let's start with Henry on the end. We call him the flow master on our network because he's the guy who has he's knee deep in the options flow day after day over there at Trade Alert. Henry, I know you've been monitoring all this insane year that was 2021. What stands out to you, the highlights and the anecdotes and the moments you really think we need to share with the audience?
I mean, I am lucky enough to get to have access to the data and play with the data nonstop. And I mean, obviously the real story for 2020 and 2021 was single stock activity and retail activity, and no matter how you slice it, that we've seen insane amounts of growth there, right? And certain market segments you look at, like large block activity was actually down last year, right? Like if you just say, just show me the 5,000 lot trades, count up the totals, even 1,000 lots, and that volume is stable, but there's no growth there. And so I think it's really interesting, and I love kind of conferences like this where everybody's trying to figure out who's benefiting in this kind of shift, who's not really participating in it, and to me that this is I've been doing this for 30 something years, and the game changed in 2000 when the ISE launched, and you had true automation come into trading. And I believe the game also really changed over the last 2 years because of the way that COVID dynamics and zero commission brokerage dynamics all kind of coming together. And what I think is most interesting is trying to figure out what's it look like a few years from now, whether the market goes up or goes down. Where do we go next?
Jordan, same question for you. Obviously, you see a lot of flow, interactive, a lot of it over there at Matrix. What stands out for you, the highlights of the insane year that was 2021?
Well, I guess a few things. I mean, it's hard to talk about 2021 volume without, going back a little bit in time, as Henry did. If you go back to like the bottom in 2020, the March bottom, and just look at the volume growth from there to like mid to late summer of 2021, you'll see that over that period of time, basically call volume essentially doubled while put volume was up about 25%. So it was, a surge of new retail investors, record new retail accounts. The Fed monetized $4 trillion of debt. You have to think that has something to do with the liquidity in the market. And, there were no sports on TV. Everybody got into, the gamification, the social aspects of being able to trade. And it became very interesting, and there's a lot of great education out there. And I think, people have really learned to understand and appreciate what you can do with options, and it's brought a lot of new market participants into the business.
Trading was the new sport of 2021. I like that. Bill, same question for you. Obviously, you look at it through an institutional perspective over there at XFA. So if you want to also cheat like these two did and extend it back a little bit into 2020, we'll allow it. But what were the highlights that really stood out from you over this insane past year?
Well, as a floor broker, 2020 obviously was the year that changed everything for us because they decided to shut the floors. So that was an interesting thing. That could be a whole subsector conversation of just the effort involved with moving everybody upstairs and making sure markets were going to open up. Not many people maybe realize, but the week that when Cboe made the announcement that the floor was going to close, it happened to coincide with the largest open interest expiry in SPX history. So there was quite a bit of risk on books that had to be handled and managed. So it was a pretty impressive task for all parties involved, be it market makers, be it floor brokers, be it the banks. But what I would say from a flow perspective, institutionally, flow has broadened out. So much of the flow over the past few years has been dominated in 5 or 10 names. especially amongst the retail community. Institutionally, I would say in the third and fourth quarter of last year leading into the first quarter this year, we've seen a much larger breadth of names that are in play. A lot of sector rotation, dispersion trading picked up with a lot of frequency, which lends itself to the index products as well. And I would also say how the institutional customers are engaging the marketplace. They are using a combination of electric along with high touch. So we can access the markets through both means to find them the best liquidity. And, you know, when we were discussing pre-panel here what we were going to talk about, you know, as Henry will allude, a lot of the orders are 1 lots or 10 lots. But the institutions play in that capacity because you might trade 5,000 options over the day, but if you execute it in a bunch of 100 lots, then it's going to show up in the system as smaller lots. So the institutional customer is still very much alive, very well, and they are increasingly engaging the market in a much broader capacity than they were in the past couple of years.
You know, Henry, one of the data points we've noticed on the network for a while has been, you know, a lot of churn out there, the day trading out there, explosions of volume that don't result in a lot of net change in open interest. Right? You can see 6,000, 8,000 contracts in the name, and the OI changes by 150 at the end of the day. I know you've been kind of tracking this as well, so what are your thoughts on that? Why that's becoming such a big trade, and the impact that may have going forward? And also related to that, I know another data points you like to track over there is the concentration of the options market. And for a long time, that's been trending in the wrong direction. We've seen a smaller and smaller number of names doing a larger and larger percentage of the volume every year. So also, get us up to speed on that. How's that concentration looking? And did the historic year of 2021, did it change anything there?
Well, I'm in the middle of updating slides for OIC in San Antonio.
Sneak preview here.
And the concentration it's funny because if you go to enough OICs, like you've lived through like 14 penny pilot panels and the repeat, strike mitigation panel was always another one, and we finally kind of got past that. But concentration has always been an issue, and the last date, so for 2021, the top 100 products made up 47% of total volume on the year. Okay, this is out of, we now have a record 5,700 underlying with options on, which is up to 2,000 in like the last 8 months. That blows my mind too. So, basically, from the bottom in 2020, the listings of SPACs and new ETFs and IPOs, it's a 45-degree line with new underlyings. The total number of strikes, I think we hit I think the record was 1.7 million in November, maybe into expiration. And in OIC, we used to always talk about, well, God, if we ever have more than 1 million listed contracts, something's wrong there, right? Well, now we're 1.7 million, nobody's complaining, but. So the breadth, like Bill's saying, is a heck of a lot better because it was 47% last year. It was 57% if you go back 6 years. Okay, so with volume up, almost 300% from the beginning of that period, right? So not only as the volume's tripling, you have the number of names that are seeing some of that volume going up sharply too. What was the first part of the question? Sorry.
The day trading percent.
Oh yeah, sure. Yeah. So another way to look at like volume, basically, in 2 years the volume is doubled in the options market, but open interest hasn't, right? Open interest is up. We may be hanging around record levels, but we're not double where we were 2 years ago. And so the day trading of options became a thing when commissions went to zero, basically, right? Because now, I've watched people scalp 2 pennies, and you're like, God, you would have never, ever thought of trying to get out of a trade after making 2 pennies when you were paying, a real commission. And now we see it all the time. We say, oh wow, 14,000 of these things traded. Like you talk about it too on your shows. It's like 14,000 traded. It's a little bit of an out of money call. Bet you open interest goes up by 2,000. And sure enough, you look the next day, and you build. All of us kind of develop tools to get a handle on what's going on. Yep, sure enough. So it's only anecdotal, but like I've seen posts in Reddit about people who are basically, their strategy is, okay, so if you want to buy a 200 lot of calls, you buy 1,000 calls and you scalp out of the 800 in the 12 minutes following your start. And now you basically put on your position for free. And I'm like, that seems awfully, you gotta have some guts to do that, but it's definitely taking place.
Well, I think, just to add a point out to that too, though, like you look at Tasty Trade, they're not trading commissions on the way out to specifically gear that type of frequency of trading. Because the reality is we don't want this game to end, right? So we don't want customers that are playing insurance agents selling options, which is what the market's largely doing, to get too burnt. So the rule of thumb becomes you make 50% on your money, buy it back and roll it, because we're not going to charge you on that roll. And that makes a lot of sense, because if all of a sudden you're paying 65 cents or $1 to do that roll, you're less inclined to do it. And the probabilities are eventually going to work against you, especially when you're selling that premium where it's going to move. You might be in profit today, but, anybody long Netflix?
Too soon, sir. You mentioned the game not ending. That's kind of the $1 million question of this panel, right? When we were first talking about doing this in January, we were hot off the heels of that last year, and everyone was wondering, can this party continue in 2022 with this insane amount of volume, all these records we're talking about here? Can this possibly persist? I've had the skeptic beaten out of me. I didn't think 2021 could do it, and then lo and behold, blew the doors off. So I'm ready and willing for anything now. But now we have a few more months of data points behind us, so we're not quite as deep into our crystal balls as we would have had to be in January. The most recent data point coming out of OCC for March was the second busiest month in the history of the business. So from that perspective, looking pretty good. And that was up 4.4%. from the year before, which was, as you recall, the middle of the meme stock madness. So March of 2021 was no slouch by any means, and this year beat it, and beat it pretty handily. Also, year-to-date average daily volume, that's the number everyone looks at to see kind of how are we in terms of on pace to beat last year's number. It was 42.7 million contracts in March. That was up almost 1.5%, so not an enormous increase, but still an increase out there. So everyone wants to know, can the party continue? Seems like we're having some encouraging signs so far. Maybe Jordan will start with you. Can it continue, or are you going to throw cold water on everybody?
Well, I think definitely there is a chance it can continue, but things are definitely evolving. So throughout much of the rally from the low in 2020, like we mentioned, to late summer 21, there's a lot of activity in upside calls, like near-term upside calls, to the point where we were seeing 20 delta calls trading at the same vol as the corresponding 20 delta put, which is not something you typically see in equities markets. It's something you might see in commodities where there is upside risk. So there is more upside risk in 2021 perceived by the market than there was downside risk, right? So late summer 21, those volume increases started to shift a little bit. Call volume is pretty much flat to maybe a little bit down, till now. Put volume has increased maybe around 20% over that period of time. And obviously, evidence yesterday with Netflix, the return of single stock downside risk, I think, is finally here. But it was pretty much non-existent for a good 18 months. The biggest risk price action-wise was to the upside.
So we need an official answer, yes or no. We're going to beat 2021 this year, sir? Everyone has to be on the record.
So we're on the trend to it. So I'm going to say yes, because I'm long volume personally in my business. So, so yeah, I'm going to vote my book.
Here is Bill. Same question for you. We're in the middle of this rocking and rolling party. Can it continue this year, sir?
I think it can. I think the index options marketplace has certainly seen an uptick, especially in SPX. You've got average daily volumes over 1.6 million contracts a day, and that's on a product line that suffered the past few years from its high in 2018. VIX markets are slow, so I don't know if we're seeing as much volatility-driven activity as we were. It's a much harder trade now, and everybody's looking for the mean reversion trade to show up to try to identify when the risk is really going to come out, and it hasn't shown up. We do see some put spread buyers here and there. On a single stock basis, I could say yes from the retail side. It's not my business. From an institutional perspective, like I said, we continue to see a wider breadth of names being played because there's just a greater sector rotational aspect to the marketplace now. Consumer staples, financials, energies. It's much broader than it once was. So if that continues based on the macro geopolitical environment, then I do think institutional volumes will continue to take higher.
All right, 2 votes for yes. Henry, you're in the catbird seat. You going to disagree there? You have your knee deep in the flow every day, sir. What do you say?
I mean, I would never disagree. I mean, but I think I said, I don't know, on one of your shows that we'll see. So we saw 2 days in January there was over 60 million contracts, almost 62 million. So 2 brand new records, of course. And I said, I want to go down on record saying there will be 100 million contract day this year. I'll still say that. Part of it, but then somebody said, well, you're cheating because, we have a couple very specific things happening. We have the 20-for-1 splits in 2 big stocks. We're not going to see volume go up 20-fold. But looking back at what happened with Apple and 7-for-1 and stuff, volume usually triples and kind of stabilizes up about twice. So hopefully we'll see more than that. And then you have a couple other things that are boosting volume. You have small contract things like the Cboe nanos, which are SPX 1 multiplier, index options, slow start, but they're there. And then you have 24-hour trading creeping up on us, right? You have overnight and SPX, and they have the Tuesday, Thursdays also, right? So there's just more stuff coming. But the overnight trading sessions, and then Robinhood finally launched their extended hours, there's this, and Bill, I'd love to hear your thoughts on it. Because some people are like, we don't really need freaking overnight trading. I want to go home and not have to worry about what's going on with the vol.
So that's all the crypto heads out there.
Well, that's it, right? Crypto's 24/7, so we realize there's an appetite for people to trade, and that's also contributing to, on a busy night we'll get 30,000 or 40,000 SPX contracts overnight. So, and remember, overnight now, it used to only start at 2 in the morning, now it starts at 8 at night, and we're getting a curve session, and so I kind of assume that other products, one way or another, are going to be tradable for more hours, and that'll boost the volume.
Bill, any thoughts on that?
We XFA actually relaunched a 24-hour desk as a result of the increase in hours. So far, it has not taken off in any meaningful capacity, but to your point, the market kind of drives that because it's more of a reactionary type market overnight, and it's one of those things where you're going to be thankful you have it when we need it, but then the rest of the time you're going to look around and go, this sucks. What are we doing here? I think again the market's going to dictate a lot of that flow. So it's there. I do think you guys at the Cboe level are smart to compete with the CME, because obviously those products are going on, and the CME's got some different rules with regard to cross products that make it a little bit easier. So to the extent how that evolves could certainly play out. But I should speak to the futures option side. They are active, and it is definitely something that we're engaged in.
All right, well, we can't talk about the insane year that was 2021 without touching on the thing that all of you alluded to, which was a lot of that volume last year. A lot of that explosion of volume was carried on the back of retail. Call them what you will. Call them odd lots, one lots, Robinhood traders, whatever you want to call them. They really rose to prominence last year, and they brought a lot of, not just volume, but a lot of interesting changes and impacts to the market along with them. Things that people who had been in the option space for a long time, we knew were theoretically possible, but to see them actually playing out in the marketplace certainly gave you pause. Things like GameStop going up to near 1,000 levels of implied volatility and hanging out there for a while and actually trading for a while. These are things that all your textbooks said you're probably not going to ever see, and yet we all saw it. And we saw it again with other meme names throughout most of the year. We saw it, as Jordan alluded to, the call skew in single stock names. That is something that is outside of small biotechs about to make an FDA announcement. You don't really see a hefty bid to the calls. And yet this year, everyone who came into the market seemed like they wanted to do nothing but buy calls. It was kind of the polar opposite of a lot of the influxes of flow we've seen in previous years, where they come in and they sell puts, or they sell calls. Everyone and their mother and their mother's mother wanted to buy calls in a handful of names this year. So that also caused enormous distortions in the volatility skew out there. And so, of course, upside crashes. We saw upside crashes, the things that were also fairly infrequent phenomenon kind of became the normal. What's upside crashing today? What insane name is exploding today? So a lot of these things that, again, we thought going into the start of the year we weren't going to see, were unprecedented, became kind of the norm throughout the year of 2021. So maybe let's go around the horn. Jordan, we'll start with you. Again, you can't ignore the impact that retail had on the markets last year. What are your thoughts on kind of the retail explosion and the changes they're leaving in their wake?
Well, I guess, just to speak of a few observations that were certainly uncharted territory, probably something that at least I'd never seen before. Like you mentioned, with, stock rallying 25-fold in literally days, what that did to the implied vol structure and the entire surface of the volatility curve went up from 100 to 500%, close to 1,000%. And at least in that initial rally, it was so distorted to the point where who's looking at a $2 put when a stock rallies from 20 to 480, right? Would anybody look at a $2 put? Probably not. But that $2 put rallied from 25 cents to $1 because of the volatility increase, even though the stock rallied from 20 to 480. So, well, technically, the stock's a lot further away from zero than it was at 20, while it's at 480. And fundamentally, we all know that elevated stock levels can, fundamentally improve a company. They can issue stock, they can pay off debt, just as depressed levels can fundamentally damage a company. Look at 2008, right? So I think some of those disruptions were very interesting to see and to see traders take advantage of some of those dislocations and see how they would correct themselves over time was definitely interesting. It's something that should be studied, in finance in the future, right?
I'm sure there are many case studies being done as we speak. Bill, same question for you, obviously from the institutional perspective. What are your thoughts on the distortions, the changes that this tsunami of retail paper brought with it? And then also, you kind of alluded to it earlier, we've heard these rumors, this talk of institutions kind of masquerading as retail, even getting down to the maybe one contract level sometimes, and spreading out their flow in that degree of granularity. So did you see some of that, and what are your thoughts about those kind of rumors as well?
Well, I think, if I would take a little bit of a diversion and reference the index business that saw tougher times outside of like I said, the fourth quarter and first quarter of this year, because the market became so concentrated amongst this retail flow and these concentrated names. Customers institutionally weren't getting a lot of bang for their buck to trade the index products when you've got 6 or 7 names that are dominating most of the move. And obviously a lot of these names also dominate a lot of the index. Last night, Netflix being the example, I think we had a great day in the market yesterday until the report, and I think the SPUs went down 40 points post the Netflix report. So you can see how these market cap companies that are dominating the index can influence it. So you got to get bang for your buck. I can't sit here and tell you that institutionally we saw like an exuberant amount of call buying. I can tell you that institutionally, look, post the pandemic, the bottom line is this: customers need electronic access to their broker dealers, to their players, because of the work fragmentation, because of the fact that people are don't know where they're going to be or how they're going to operate, right? So institutionally, order flow has definitely driven a more electronic, more smart router. We do work 10,000 lots over the day, which can show up as a bunch of 20 lots if that's how they wind up getting filled, which contributes to those smaller statistics that Henry points out. I can't say that we saw a dynamic amount of leveraged upside buying and calls on the institutional side. They're big enough players where they'll buy the stock, and if anything, take advantage of that skew and seek to override.
Dump the calls in. Henry, I know you've been watching a lot of this. You did a lot of work on, as you term it, the rise of retail. What are your thoughts, sir, on their impact last year?
Well, it's funny. I listened a lot to Dean Kerna at Macro Risk and worked with him at B of A, and we talked about this inverted skew situation. And I have one chart that basically just counts the number of inverted skew symbols on a daily basis, right? And it's, it was always kind of like, there's a few dozen, right? Because they're biotechs or they're takeover candidates, where it kind of makes some sense that your upside tail is fatter than your downside tail. And then you get into 2020, and it's about 8 times as many on a daily basis. But Dean kind of pointed out, at first everybody was like, geez, this is nuts, right? And the markets don't crash up, they crash down. So this is an opportunity. A couple things that came out though. One is, and Dean did work on this. Because the stocks were crashing up, that skew is completely justified, and so it's more a matter of the market reacting to like, oh wow, so there is a stock doubling is a risk now, especially if you can figure out which stocks are potentially going to catch the meme wave. So that was part of it. But a couple other things on it. But one of the other interesting things was if you look at like GameStop and AMC clearing data from OCC, that they release customer firm and market maker stats, right? Totals. And there's certain products where where firms do 10, 11% of the flow, and then market makers and customers make up the rest, right, against each other. In these super crazy meme names, the firms were not in the mix at all. Firms were like, we don't know what the hell's going on here. And on top of that, the flow's all coming in through, if it's very retailish, it's all getting basically routed to a consolidator. The firms don't really even have any access to that flow if they wanted to. So they stayed out of it. But one little data point is so Blair Hull was my first employer in the business. I still talk to him, and he basically has started a call tail selling operation. So he's like, and I mean, even when I started the business and I didn't quite understand too much, I did know we made decent money selling puts. Okay, that was, as a market maker, this was more of the old-fashioned flow, and the overpriced puts were your bread and butter. And the way Blair's looking at it now is it's flipped. Now basically people are paying, overpaying for calls, and so I hope he's not just selling everything out there, but he's basically said that's the way he's looking at the market is, and so like I want to write an article on are calls the new puts, because in the olden days they were overpriced and people sold them. Is it all flipped around the other way now, where the mispricing, like the structural mispricing, is going to be on the call side? Is that what's going on?
Well, that's the point. That actually became a big talking point last year. It's kind of surprising. A lot of people were starting to debate whether we were doing it wrong, whether we are structurally, as you mentioned, mispricing out of the money calls. But you're right, it was not a debate that was really ever raised before. It was always focused on the puts. Sounds like Blair has his thoughts on how that should shape out. But that's been an interesting debate. We saw that rear up a lot over the course of the past year. So it sounds like you're in that camp, Henry, that the out of the money calls these days are in the wake of the meme tsunami, are maybe a wee bit underpriced, or shall we say mispriced, and we need to maybe address that going forward, maybe by nakedly selling them like Blair.
Well, to play off of that point, I think that there is that structural inefficiency for sure, but it's happening in the 60-day option. And it's a very interesting trade. And if you look at a lot of the retail commentary that's out there online, especially in the educational forums, everything's been geared towards the weeklies and 1 days, and you can't fight the statistics on that. It proves it. But the reality is that, again, I hate to keep calling out Tasty Trade, but somebody that I follow a little bit and watch Sosnov, he brings up a lot like retail players can sell naked calls. We don't see stocks go to affinity all the time. And if you take a look at the SPYs as a great example, and you look at the probability analysis, there's a wonderful trade that exists between the 60 and 30-day options that I think retail is taking big advantage of. And they're going out to the tails, specifically on the call side. They're selling it, and they're then buying it back 30 days later at a very significant discount. I think they're learning to play theta on a longer perspective than just the 7-day option or the 2-day option or the 1-day option. I don't know if we're going to launch 1-hour options on SPX. I mean, maybe. But the point is I think retail has kind of woken up to a much broader array of strategies and a much different risk tolerance. And if we all talk about will this continue, obviously those trades can wreak some havoc if we go the wrong way.
Jordan, same question for you. You kind of alluded to it earlier, how the calls are getting mispriced. As Henry puts it, are calls the new puts? Are they completely mispriced in the wake of this retail explosion?
Well, I mean, I think, a 25-fold increase in a single stock in a matter of days was completely unprecedented. So, I look at whatever model you're looking at, that's like 20 standard deviations out of the norm, right? So I think that put that upside risk into everybody's model to the point where they couldn't sell, infinite upside calls, because there is some probability that stock could rally tenfold in days. And it doesn't matter if you're right about your position at the end of the day. You have to be able to hold your position to the end of the day, right? So, some of these positions, I think the risk of being, unable to hold it to expiration, for example, if that's your ultimate goal, greatly increased. So it lessened the demand on certain people putting on those types of upside risk positions, which lowered the downside pressure on upside vol and increased the upside pressure on upside vol. So it all makes sense to a certain point. I don't know when the next time we'll see a GameStop situation again, right? Over time, that kind of risk premium on the upside will slowly dissipate. We'll forget about it. In 25 years, it'll happen again.
Well, everyone here, we've kind of been talking about this, this retail juggernaut, this volume tsunami, and it's been a great thing for a lot of people in this room to have more people participating in these markets, but there are some people who are starting to get a little bit skittish and have been for some time. A lot of this retail explosion, as you mentioned earlier in the session, we saw options notional volume eclipsing stocks for the first time. And when the regulators see a lot of new traders piling into options, they just get worried. It's just a matter of course. Now we have this new phenomenon, as you mentioned, Henry, the self-directed trader, no commission. So the traditional gatekeeper that used to be there, their financial professional, the broker, the advisor, whoever that was, who was kind of the intermediary between the retail and the options product, that's gone. That's gone. So it's just retail diving in, self-directed now into these products that the regulators deem to be complex. So that has them doubly worried now. And then, of course, we saw over the course of last year very aggressive crackdowns, record-making crackdowns on firms like Robinhood and others for approving accounts for options that very clearly never should have been approved. So, we're seeing regulators, FINRA, and others starting to put out comment letters about this saying, maybe we need to pump the brakes on this a little bit. Maybe people are getting a little bit ahead of their skis on this. So I'll put that question to you. We're still in this modern era. We're doing volume numbers we never really anticipated doing. We're seeing unprecedented things happen on an almost daily basis in the options market, yet we're still kind of chugging along with these, level 1, level 2, level 3 account approval system that was set up decades before most of these new traders are even born. So is it time to revisit that? Maybe try to change it and make it more nuanced for the new 21st century trader? Or maybe is it perfect the way we have? And we'll go back the other way and start with Henry.
Well, education in the industry, I think, has been a weak spot for forever. Honestly, it's just whether, I've worked at some banks and, there seems to just be, I guess, not that many people understand options and are comfortable with it, and there's such a fear of suitability and some customer doing something because it was recommended that the brokerage space. Sosnoff and Tasty Trade, at least they put out a lot of content. I didn't know that they. I always thought the no commission to close the trade was the responsible. We want you to close this thing when it's down to 12 cents or a dime. You make it sound like maybe it's slightly more gamification of it, but
certainly drives volume.
Yeah, I guess so. But education's always been a weak spot, and unfortunately, I think people in the last 2 years that are a lot of these retail accounts trading options are learning it from freaking Reddit. That's their educational process, and that's obviously dangerous and not a good thing. I don't know how to get there, but I absolutely think that that the industry needs a much more modern, something that will teach people to trade responsibly and to have realistic expectations and not YOLO their $6,000 account on AMC calls. But that's what we got, and if they made 5 times their money, then they told their friends, and it just kind of snowballs.
Yeah, that's a good point about education. You're right. Outside of the Options Institute at Cboe, there's not even an exchange that has a stake in the education game anymore, which is a sad development for the options world. They've left it all to the brokers and to networks like mine to kind of carry the load. I'd love to see more people out there on the education front. But Bill, same question for you. Do we need to rethink how we do this options thing in the wake of this? Everything else is changing. Maybe it's time for 1, 2, 3 to go away too.
Yeah, I can't really comment from the retail perspective. I certainly recognize the risks of the situation, but I'll leave that for the regulators. What I would say to you is, shifting gears again back to the institutional side, and having had some recent conversations with the banks, the banks got hurt not too long ago, especially with the Archegos fallout. Not to say that they didn't kind of self-induce it trading with that guy, but the point is they really have got a lot of risk on the exo books, the exotic books. Banks don't trade property anymore, but they do trade exotics. And when you talk to some of these traders about what's on right now, and if you think about the macro geopolitical situation with interest rates and with everything that's going on with Ukraine, Russia, and all of the probabilities of outcomes, and then how complex these exotic trades are, it is going to be interesting to see how they, as a component of the industry and a significant component of the institutional liquidity in the industry, handle that business. Because in speaking with a lot of these traders, they have shut down a fair amount of accounts, they've shut down a fair amount of positions, and that's kind of a cool place and a funky place for the institutional customers to go play some really cool, swap bets, interest rate bets, oil bets, all sorts of stuff that they have on the books. So I think it's going to be interesting to see how the regulators look at that, especially if Gensler, takes a deep dive into that with what he's doing on the uncleared margin rules side.
Jordan, same question for you. Do we need to radically revamp the way we do things in the options space, or is it good the way it is?
Well, I mean, I won't disagree that education's always been kind of an area that's needed improvement across the industry, but that said, it's probably never been better than it is today. So, I mean, a lot of retail brokerage firms have done a very good job on informing clients prior to entering an order into the system, what their risk reward looks like. They'll know if they're entering an unlimited risk position. So, if you break it down into as simple as position risk and execution risk. On the position risk side, the client needs to know what type of trade they're putting on and what the risk profile of that trade is. At a minimum, I think that base is covered pretty well across most major retail brokerage platforms now. On the execution side, ideally, the retail client shouldn't have to worry about that. But, they can put in debit spreads at a credit. They can put in a market order and a thinly traded option pre-open, and, one exchange opens, one bid at 2, and you don't necessarily want to fill it at 2, for example. So that side of it, at Matrix, we have a growing retail consolidator business, and we've put a lot of effort into putting in guardrails to kind of prevent, poor execution quality on those edge cases. Obviously, everybody's looking at execution quality. We compete very well in the execution quality group. But, those edge cases, you may have a couple that happen a day where it just creates a poor experience for a retail client. And to eliminate those, from happening, you'll get that client back and they'll continue to trade options because they don't feel like, they put in a market order to buy and, they bought it at 2 and that was the high for the day. And the rest of the day it traded 140, 145. That's just not a good experience for anybody, right?
Since we're talking about the way we approve things and regulate, really quickly, I want to get your thoughts from you on this. We saw in the last couple of weeks the return of some truly complex products, the return of XIV now in the form of STAC, right, which is, of course, the inverse volatility product. It has inherent optionality baked into this product, and yet we saw what happened in 2018 where it went the way of the dodo, took a lot of retail listeners of our network and traders out there with it. And so a lot of people, when this got approved again, a lot of people were not happy, quite frankly, that this would come back. So I'm curious for you folks here, maybe aside from the level 1, 2, 3 issue for options, do we maybe need to extend that maybe to some of these products that have inherent optionality in them, like these inverse or levered ETFs out there, which when you go to a lot of brokerage platforms, they're up there next to, a SPY and some of your other plain vanilla ETFs, and kind of just click them and you think you're getting into a very basic trade. So maybe do we need to extend that conversation a little bit further, maybe try to put some barriers in place between people who don't understand these products and the products that are coming back to them? Maybe Jordan, really quickly back to you.
Okay. I guess I would say that it probably is good to notify clients if they're trading a product that doesn't trade like a traditional equity, right? So all equities, their historical distributions are leptocritic, negatively skewed. People kind of understand what the risk is. But if you're trading a product that has a completely non-standard distribution of returns, they should probably be aware of that. Now, in the equities market, at least, we know what our downside risk is. It's 0, right? It's not like oil futures that can trade negative 50. So at least we know our downside risk is 0. That's good. We always knew that our upside risk was quote unquote unlimited. We didn't know how bad unlimited could be, right? So I think we know that now, but some of these products definitely do amplify that. And it would be good to, make clients aware that it's not a standard equity, distribution of price returns.
Bill, same question for you. Do we need to extend that kind of approval system to some of these products that have inherent optionality to them?
To what Jordan said twice.
There you go. Succinct. Henry, do you echo that as well, sir?
Yeah, I mean, when you have, and there's a lot of complex ETFs, right? And if someone comes up with an ETF which is just 5 times levered via calls, then they're just trading options. So they should at least. It's a little dicey if that they don't even realize that when they pull it up in the screen.
Tend to call them poor man's options or
They didn't realize that because that V goes to 80, it closes down, right?
Exactly.
I mean, there's your answer.
They didn't need the prospectus. Speaking of 2021, another big development, and I said we're missing one of our panelists here who could really speak to all this a lot, but this was the year that crypto, not just crypto, but crypto derivatives exploded into the mainstream in a way that we haven't seen before. I think it's fair to say that, Bitcoin ETH options really hit big time last year. Just some light data points here. So the centralized stuff, the CeFi stuff, Bitcoin volumes hit around 1 billion to 1.5 billion worth of notional a day. It may not sound like a lot, but that compares to 350 million in 2020. So you're talking massive order of magnitude increase. For Ethereum options, it's even bigger, 800 million a day in terms of notional volume. Again, it may not sound like a lot, but it was 50 million in 2020. So you're seeing just enormous explosions. Deribit, which is the largest crypto derivatives venue around the globe, they do about 95% of the flow. Their OI hit about 7.2 billion worth of notional volume on the Bitcoin options, ETH about 6 billion. So it was quite the record year for crypto derivatives. We even saw towards the latter portion of last year the explosion of some of these more esoteric crypto derivatives. And if you want to think twice about how options are utilized and you think you understand everything, go look at what they're doing in the crypto space and you'll say, wow, I never thought of that. Things like the DeFi option vaults, which became all the rage towards the latter half of last year. If you don't know what that is, it's a very basic structure. You put your assets into your crypto into it and they use to deploy in fairly vanilla strategies, yield harvesting, covered calls, and cash secured puts. But even still, people are getting anywhere from 15 to 50% in terms of yield, depending on how they set these things up. So there's a lot of esoteric, new, interesting things being done in the space. And of course, I think most relevant for this audience was October of last year when the ProShares BITO ETF launched. That was very much a seismic shift in the crypto derivative space for the first time. A lot of the audience out there who have securities accounts who've been dying to trade crypto, Bitcoin options, ETH options, whatever the case may be, they can't go to Deribit. They're banned by regulation. They can't trade there. They have the CME products, but they're very big. And they don't maybe want to go to the futures side. And now they have this ETF that is trading the CME ETF or CME futures for them. And this one exploded out of the gates. This was the fastest I had ever seen OCC list the options. Within 48 hours of the new ETF listing, we had options trading on this, which was almost unheard of there. And the numbers are still strong. It's still averaging around 60,000 contracts a day. So BITO is here to stay, and people are trading it en masse. So I'm curious for each of you, what are your thoughts on this explosion of new crypto derivatives volume? And then what does that mean for the traditional options volume? Is it bringing in new participants, or what are we seeing? Maybe Bill, we'll start with you.
Well,
Mr. Crypto, I know.
Yeah, right. Institutionally, we're not seeing it. That doesn't mean it's not occurring. It's electronic marketplace. We're very curious at XFA to see if a high-touch market eventually was to develop. I kind of question whether that's going to be the case because it's such an advanced market. I think it's going to remain a lot electronic. Not to say that if big trades don't eventually come to the marketplace, there won't be a market for it. But I wish I had more for the audience. I don't. In terms of, we're not seeing it institutionally, and I think it's occurring electronically. I think more on these guys for
Henry, I know you've been watching a lot of BITO in particular out there. It has been lighting up the tape. What are your thoughts on BITO and potentially, we were just talking about the retail tsunami. Now potentially we have this new crypto tsunami who are starting to discover these options markets.
I mean, I think that the crypto, just the whole friggin' evolution of this sector is a really interesting phenomena, and it kind of shows you, I guess, in the absence of regulation. And I think we all know some pretty smart people that left our industries and see, I'm going into crypto. And it was really, and and they're doing, even people that don't believe in crypto that I know are like, listen, I don't know if it's what the hell, but I do know there's smart people trying to come up with, putting together, intelligent systems. So if it may be weird that it's looking for kind of a core purpose, but you've got a lot of brain power in that industry. And as a data vendor, I love to see what Genesis was coming up with, and it was spectacular ideas that were just 2 or 3 smart guys could put something together and crank it out and launch it, and then the efficiency of being able to, I put Solana in one of these vault things. I had no idea what I was doing. A guy, my IT guy walked me through it. He said, okay, move it to your wallet, now click here, now click this button that says that you're making 37%, and he's like, yeah, you're done. I'm like, what did I do? He's like, you sold some calls, maybe. I'm like, are they like cash? Or is cash settled or physical? He's like, well, I don't know. And I don't know either. And I'm an option guy. Like, what will happen if Solana goes up to like 110? And yeah, I mean, I don't know. I think they send me back some dollars or tokens or whatever. But the efficiency that you can see in that market, I think, is spectacular. And when BitO launched, and I was amazed that it took them a day to launch. And I was like, what about this whole for stocks, the rules are super specific. You have to have 4 trading days above, and all these holders and all this. And I guess for ETFs, the rules weren't there, so there was nothing to stop it. I think maybe these crypto ETFs are a little late to the game because we didn't see the kind of explosion that where people were thinking. Like, holy cow, you've got millions of securities accounts, and now somebody can just basically buy this and override it and make some yield, and just doing it via ETF and ETF options. And that seems to be, kind of lukewarm. Even though 60,000 contracts a day is great, and it certainly, makes it into probably the top 50 ETFs. But it's not, it seems like the existing platforms and the innovation that's out there kind of still dominates the audience for that.
Jordan, same question for you, sir. What are your thoughts on this new wave of crypto options traders and products like BitO maybe changing the game a bit?
Well, what's interesting to me is that Bitcoin is probably the most successful globally fungible product ever, right? You can trade the same thing anywhere in the world, right? Its derivatives markets are the most non-fungible, fragmented markets possibly in the world, right? And you kind of have four main models operating.
Right? Sounds awesome. This vault.
So you have the derivative model, the crypto native model, right? So they operate 24/7. They have first mover advantage. We, unfortunately, unless you have an offshore account, we can't trade those. Then CME's been pretty successful. I think that there's contract spec issues or variations between all of these. There's capital cost issues for everybody that was currently trading the CME complex, the Bitcoin futures and options and Ethereum as well. We're very efficient for them to trade. And now with BitO, to me, it's really opened up that market and, Bitcoin options to a new investor class. It's not stealing anybody from Deribit, because if you're trading 24/7, why would you want to only trade 6.5 hours a day, right? And then the fourth, really, though, is the OTC market. So in the spot crypto market, it's said that anywhere from 50% to 80% plus of the overall volume is executed in the OTC markets, not on quote unquote lit exchanges or venues. And the same thing may evolve with options as well. So a lot of the big liquidity providers in the US have crypto desks. They're starting to deal options over the counter as well. So possibly that's where institutional growth in the US happens. It's clearly not going to happen on Deribit just because of regulatory issues. But it's definitely interesting to see those different models compete.
We're kind of coming up against it, so we're going to merge our final 2 topics here. First off, one of the other big trends we saw in 2021 that was very game-changing was the fact that everything big became small. We saw, the death of the big S&P futures and options, and in their place we got weeklies and dailies and minis and micros, and Henry's working on nanos over here. So everything small became huge in 2021. So I'm curious for you guys, your thoughts on that. Is this just a fad, or is this kind of what we have to do now because everyone's trading fractional shares? Small is just a fad, or is this kind of the way the options market is shaping up for the foreseeable future? And because we're kind of coming up against this, leave the people with some forward-looking statements. Let's look ahead a little bit. We have obviously a lot on the horizon for 2022. We have this rising rates, inflation. We have this ongoing war in Eastern Europe. What are some things you have on the horizon? What are some things you're watching in the options market going forward? So a combo question. We'll start with you, Jordan.
Okay, so I'll try to go kind of quick. Part of the miniaturizing of options multipliers in the index space for sure is just naturally needs to happen, right? The SPX index level is up tenfold tenfold in 25 years. Inflation's only up 70%, 10% in the last 9 months. That's not great. But so basically, it's 6 times more expensive in real dollars anyway. So you do need to reduce multipliers on those contracts to even just keep the existing, kind of nominal client base that you have. In terms of other products, to the extent that the industry can efficiently handle, additional strikes, additional expiries, additional underlines, and efficiently quote those, provide efficient markets to clients, reasonable spreads, reasonable liquidity, reasonable latency profile. I mean, the more the better, because it just appeals to more and more clients, right? Like you said, we're at like 1.6 million individual option contracts now. And as long as we can handle those efficiently as an industry, that should continue to grow, in my opinion.
All right, Bill, same question for you. You had kind of a front row seat for what happened with the S&P 500, everything going small last year. So what are your thoughts on that trend? Is that here to stay or kind of just a fad in the options market? And also, let's leave the people with something you're keeping an eye on looking forward for the rest of this year. So.
Institutionally, they still prefer the larger contracts because they have larger size to do. We executed a beautiful transition out of the big S&P contract into the E-minis. We have a very dominant place in that marketplace, and we are seeing really a seamless transition. We didn't know if customers were that traded the big S&P futures contract were actually going to try to convert to SPX or not, or they were going to go to the E-minis, and largely pretty much 100% went to the E-minis, especially with the way CME lowered the block trading levels and the block rules. So I would say that that's been a relative non-event. We really haven't seen a volume fall off. And I do think institutionally they prefer the 100 multipliers and whatnot, just because of the size they have to do. So I think we're kind of talking about two different segments. I think looking forward, we've seen a dramatic increase in Eurodollars business. I think the interest rate is really the name of the game looking forward. We're really concentrating on that in terms of what kind of volatility that can provide the overall marketplace. And again, we're seeing a lot of interest institutionally in the ETF space, particularly FXI and HYG. And that's growing in the sense of not only size contracts that are trading, but more importantly, the amount of customers that are calling us with that. So I think that you can continue to look for opportunities in China. You continue to look for opportunities in the equity space related to fixed income.
Henry, we'll leave it with you. You're Mr. Nanos now, so you're a fan of the small space.
Don't call me that. I think the Nanos are really interesting. I'm old enough to remember when they took the big multiplier for SPUs from 500 to 250. I was a Solomon, and I remember going, wait, they just doubled the commissions on us. Like, this is bullshit. And from that standpoint, I thought, this is just a scam. But now we're for exchange, so I better not say that. The truth is, though, like Jordan said, indexes don't split, and Netflix gets to split, Tesla gets to split. So you do have this creep up where all of a sudden, you get to a product where the notional's, $450,000 for one lot in SPX, and people are like, geez, that's a big trade. So I think I think the industry needs to kind of figure out what our priority is in terms of small products, because the Nanos, there's an issue with fees, and they're currently, I was the biggest trader in there on one of the days because I traded 120 contracts, but it's not, they're not functional yet. They need zero commission retail embracement of the activity, and then some of the structural fees in the clearing and stuff kind of really need to reflect that there's some of these small products. So what I'm excited about going forward though is the technology, the capabilities. That 62 million contract day in January, there was no exchange hiccup whatsoever. You didn't get one of those emails saying Amex has declared self-help against Philex. None of that. It just worked, and that capacity is spectacular. So as more products come in, and with 1.7 million strikes, and I'm sure we'll hit 6,000 products this year. And the fact that this is all just flying without any big technical hiccups, means that the possibilities are kind of wide open.
All right, that's all the time we have. Join me in giving a round of applause for our panelists. Thank you, everybody, for spending your time with us today.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.